Hans, you've gotten more surprisingly than this is, I couldn't believe it. Are you bullish? Have you gotten bullish with this sell-off?
The things have gone on sale.
Kicking and screaming into a bullish, you ended up looking pretty good. So 11% for the year from where we are now.
Yeah,
up.
I think up.
Okay.
Yes, let's be clear, up. 2768 is the target for the year.
2768 on the S&P.
Yeah, on the S&P 500. And that's driven by lower than expected earnings growth, modest multiple, and it gets you there. If we did this exercise a couple of weeks ago, the return expectation was going to be quite a bit lower, but that's the benefit of having the market correct a bit, as we were expecting, and so it sets us up, I think, for a better entry into 2019. I think the theme here, though, that we have to keep in mind is slowing but growing. Yeah,
and 2.5 to 3 for GDP, you think that's doable? A lot of people would sign on for that for 2019.
Yeah, I think that's doable.
Really?
It's going to be below, what we've been running at in 2018.
It's like 40 or 50% higher than what the new normal was supposed to be. If we can do that, that would be a win, I would think. Now, the 10-year Treasury yield, I don't know when you told us this, but you say it will be range-bound in the year between 3 and 3.5%. Well, it's already well below that range this morning.
Yeah, but that move has really happened over the last 2 to 3 weeks.
In response to the equities.
So you get past some of these uncertainties, and I think a more normal state will be some premium over the short end, right?
Yeah.
Through the course of the year, that would put you up above 3%.
So why is Tina dead, though? Because short term, you can, and that is, there is no alternative. You think that with the 2-year where it is, that is an alternative, or cash is an alternative?
Yeah,
really?
Isn't that amazing? You start to get a real return on cash.
But it's not 11%, so you're not recommending it.
It's not 11%, but it doesn't force you into equities of various flavors as it has in the past. So you can actually conserve the purchasing power of your capital if you sit in very short-term debt now, which is decidedly new.
So Sarat, you just heard all that. You more bullish, less bullish, or you have similar views to Hans right now?
So I'm more bullish.
You're more bullish than that?
I am, because I was bullish even when we were 10% higher. And I think where valuations have come down at 15 times, even lower now, and earnings expectations really coming down almost every day. Any upside, any surprise to the upside, not just here, but globally, I think will take these markets to a different place. Now, 2%, I don't disagree with you, is an alternative, but that, I think, takes away from some of the sectors in the markets that people were hiding out in, and I think you'll see more investing in other sectors, so moving away from the utilities and maybe some of the lower growth REITs, et cetera, consumer staples, to more of the industrial cyclicals that now not are trading at 14 times or 15, are trading at 10, sometimes even 7 to 8, and multiples today that we haven't seen since probably 09.
The idea that earnings estimates are coming down and obviously a slower outlook is being priced in, undeniable, but the process of going from where we are right now, 7 to 8% for S&P earnings growth this year, and getting that down, even if the market seems like it's already priced in.
You think that's still too high? You think 7.8% is still too high for earnings expectations?
I think if we're going to have a typical trajectory right now, you're seeing all the global PMIs suggested. So that process is messy, right?
It is extremely messy, and that's the equity risk premium that people have to take into consideration. When you're an equity investor or a non-bond investor, these are the ups and downs that you have to go through. Now, hindsight's always fine, and you look back and say, oh, that was a great year. But you got to kind of live through this and say, I got to have conviction, and I got to stick to my allocation.
But that's really interesting. When we talk about valuations, we're doing it based on what the earnings estimates are right now. 7.8% for the S&P 500. Yeah, Tim Freeman was just saying off air that we're now looking at 12 times forward-looking earnings.
No, he was saying 2020, right?
Oh, was that 2020? Okay.
So, but still, I mean, it's a very modest look. I think if you think the earnings are coming in as forecast right now,
right,
market's very cheap. I think a lot of the risk has come out of the market. Right. The question is the rest of the macro data telling you that
there's going to get dragged lower?
Hans, I mean,
I think you're right. I mean, because when you start factoring in the currency impact, the calendaring,
oil,
the tax cut, and then oil, which I don't think people have really started to put into the numbers. And you look at the numbers themselves, they're coming down at a pretty good clip every week.
It was 10.1% at the end of September. Now it's 7.8%.
You don't do targets, do you, Sarat?
No.
But you think is 11 on the low? 11% is on the low. I'm ready to sign on for down 5 earlier, so you can.
I mean, that's like sell all your stock and put it in cash. Then.
Not really. No, I'm just saying if I could just guarantee that it wasn't down 30.
If that's kind of your perceived floor,
right,
then. that's not bad.
But I see, along the way, we could have some of these rocky rides. We saw just the last week when you were supposed to be really quiet, and all of a sudden the markets can move 5 to 10% now within a week. Now we're getting back to the area that we all forgot about 5 or 6 years ago. But if we live through this and we kind of get through some of the uncertainty, oil stabilizes, you get some type of conviction as to what's going on in trade policy, you could see the markets come back and a lot of people kind of being left behind.
Hans?
I think we're at a point in the cycle where, as it ages, things tend to get more fragile. And whether it's the geopolitics, the geoeconomics, trade, et cetera, they all start to exert themselves much stronger on both the psyche and of investors and the prices. And I think we're in an environment where this volatility that you're talking about is going to be one of the things that we have to deal with this year, just as a function of where we are in the cycle.
If it's kind of a scare, if this is a global scare, the way we saw in 2015 and 16, oil crashing, credit acting up, earnings estimates coming down, industrials kind of having a tough time. You did have a 15% high to low move in the S&P 500. If you go back to what got us out of that, what were the pieces, right? I mean, you did have a dovish turn by the Fed. Fed went on hold for a year.
Right.
Oil bottomed. Not sure if that was something anybody did or just kind of happened that way. And Chinese stimulus seemed to take hold, perhaps.
And remember, the dollar had quite a run in 14-15, and the dollar and oil combined created a recession in earnings during an economic expansion, which is exceptionally rare.
Yeah.
I don't know what turns it this time, though. So, and as the cycle ages, it gets back to that earlier notion.